Hello everyone. Welcome back to our speaker series. I'm very happy today to welcome Professor Ruslan Goyenko. So Ruslan is a associate professor of finance at McGill and is a prolific researcher. Usually work from the start on liquidity risk, but now his research is also mainly focused on the application of machine learning, going from reading in the mind of executives toward trying to find a trading alpha. And this will be the topic of today. So today, Ruslan will show us how we can use machine learning to try to predict trading volumes and to transform this predictability into some economic value. So very happy to have Ruslan today. I want also to thank Mirco Rubin, my colleague, that accepted to act as a co-moderator, and also one of our bright students from the ABC of Financial Engineering, William Gauthier. So without further ado, Ruslan, the virtual floor is yours.
Okay, thank you for having me here. Thank you for the invitation and such an amazing introduction. I could never introduce myself better than Emmanuel just did. I have 40 minutes, right? So it's a joint work with the Brian Kelly, Toby Moskowitz, Yunan Su, and Chao Zhan, and this about trading volume alpha. It's essentially, you mentioned, Manel mentioned previously I did a lot of research on liquidity, and this is sort of continuation to it, but a little bit into the machine learning perspective here. So let me just tell you a little, I'm gonna go fast, but please feel free to interrupt or send questions in the chat. But a lot of us price and literature focuses on predicting returns, but it's getting oops, sorry. Oh, let me figure out how this. Okay. But predicting return is becoming overly exaggerated at this point. It's hard to predict returns. I mean, this is while it's the most straightforward variable to look to predict, it's the hardest variable to predict. And some literature started looking into, and especially a lot of practitioner literature also started looking at other variables which are more fundamentals, right? And if you predict fundamentals that have eventually, at least historically, lead to higher returns, you kind of are going to get to the returns eventually. And if you also look at the whole factor literature, the factor analysis, right? So those are the fundamentals which historically, at least, lead to higher, lower returns given the factor. So that's where we're coming in, and we're looking at other variables than fundamentals, than returns, and we're going to look at the volume, right? So trading volume, right? So why trading volume? Essentially, let me go back a little bit here, is that if you think about us like empirical asset pricing literature, everything is focused on the returns, right? So, and when it comes to frictions, which is very important part of asset pricing, because not everything survives limit to arbitrage or trading costs. We're going to talk about the T cost, right? When it comes to market frictions, normally it is taken as a fixed or given, right? So you kind of assume it's a certain kind of threshold on the T cost. And you're focusing on predicting returns. But we all know that T costs or these trading costs are not fixed. They are quite dynamic, right? So what we're going to be looking here is that the essentially completely reverse, opposite. Instead of predicting returns at taking T costs a given, we're going to be predicting T costs, right? And then we're going to fix the returns as more or less given and see how much of alpha we're going to generate by actually dynamically timing T costs and how much of alpha we can contribute to eventual returns, right? So this is sort of, if you think about it, it's kind of merger of trading, microstructure literature, or kind of the trading cost literature and asset pricing, but the perspective of really coming from a microstructure point of view, predict those trading costs. And we're not the first to predict trading costs, right? So the whole literature is predicting trading costs, right? But they don't predict it in the context of portfolio optimization, and that's the big different thing, right? So they're predicting it unconditionally. We're going to be predicting this trading cost conditional on that we want to trade, right? So, and we want to get into these sort of in our position. We don't have the whole year to get in that position, right? So we basically wanna trade, and we're gonna be timing, and then we're gonna be measuring how much of basically dynamically trading favorable conditions to trade can contribute to eventual increase in our portfolio alpha, right? So that's why the name is trading volume alpha, right? So again, you can predict price to sales ratio, PE, the earnings surprises, and all these margins. But at some point, you need to buy, right? And if you're a big fund, and trading costs can be substantial. So here is how much of alpha you're gonna gain when you actually time in your buy or sell decisions, right? So that's what we're going to be doing. So the trading volume, it's again, it's highly predictable. So especially using machine learning, okay? And that's where all the big data coming in. So what we're going to do is we want to connect our participation rate in trading through this trading volume, and that to optimize our trading cost. And then we're going to estimate the economic benefit of trading volume alpha, right? If we are actually kind of strategizing our participation rate, given our predictions, then how much of the benefit we're going to gain from this conditional trading compared to unconditional, just basically prediction, right? So the key idea here is that trading volume is extremely widely available. So, and when I also teach trading class to students, and we have this graph of intraday volume, right? It's U-shape. In the morning, there's a lot of trading. Volume is high, then it's lower in the middle of a day, and then it goes up again in the end of the day, right? So, and when we teach this case of trading, so we always suggest like your participation rate, if you want to trade at the average kind of market liquidity, right? So VWAP, for example, your participation rate should be proportional to volume. So you trade more when the volume is higher. Why you trade more when the volume is higher? Because the liquidity is high. So your price impact is lower, right? So so here is not intraday, right? So here is basically gonna be daily, right? So you're gonna we're gonna predict a daily volume. But the idea is the same. You want to trade when you're on the day when you're predicting the volume is high, because when the volume is high, your price impact is lower, so your trading costs are lower, right? So that's the idea. And if you're predicting the volume is going down, going to be lower, you trade less or don't trade at all, right? So essentially, so that this is kind of, and given the volume you predict, you basically create your participation rate, and this participation rate also going to be proportional to the price impact is going to create. But essentially, there is also in the there is a trading algorithm percentage of volume, right? So essentially, that's what we are looking here. Your participation rate, percentage of volume you want to trade when you predict the volume is higher. So the idea is you want to increase your participation rate, then the volume is higher. You still with me so far? So it's very simple. It's extremely simple. The only difference from what other people been doing is that we want to predict this volume in the context of portfolio optimization, right? So yeah, this is quite different because it's going to be conditional on what we want to achieve, and what are our target objectives, target weights of the stocks we wanna lock in, and what is our trading horizon. So, but eventually, all of these to bring to the net of cost alpha that we can spare in returns by optimizing our trades. This is a short talk, so I'll skip some of the slides. So we're going to predict volume on a daily basis. So our sample is 2018 to 2022. So this basically tells you when we started the paper. It took a while to finish this paper. So it's 5 years of data, and we're going to predict volume with a lot of data on the stock level across all stocks. We're going to have overall for 4,700 stocks in total. We're going to use machine learning to do that. And as for machine learning is concerned, you need a training sample for it, so that algorithm learns first, right? And then we're gonna use 3 years, first 3 years to train, and then we're gonna keep all the hyperparameters without training, and we're just gonna go into testing the last 2 years of the sample. So that's how we approach this. The predictors are coming. There are several categories of predictors, but overall for each stock, each day, in the end, for the biggest data set, we're going to have 175 variables. So it's going to get 175 predictors. They can be daily, monthly, quarterly. So the general firm characteristics predictors are coming from Jensen, Kelly, and Peterson 2022 GF paper, and then created the whole data set, right? So they coming from there. There are technical predictors, the signals, the moving averages, the lags of the daily, and a different combination of 5-day, 22-day, and so on up to 1 year. We're gonna look at the other variables like earnings, index rebalancing. This all part of this data set. But it starts increasing. So from purely technical signals, then adding firm characteristics, then adding the event. So just about what we are predicting specifically, and this is important. So volume itself, trading volume itself is persistent, right? So high volume on average kind of continues the next day, right? So the only difference coming in what we are going to predict is we're going to predict the shock. So this is the density of the level of log of a dollar volume over here, and this is the shock. And the way we measure the shock is the difference between volume, dollar volume, log dollar volume today and moving average of 5 days, right? So it's kind of like a weekly shock. So why we want to focus on the shock rather than level? It's essentially the whole idea is that you are timing increase in volume. That's when it's more optimal to trade, right? Versus decrease the volume when you want to trade less, right? So if you look at the average volume, you can trade the same amount every day. But here we want to when there is a positive liquidity, more liquidity, we don't trade constantly every day. We're going to increase our participation rate. So here that's what coming like extra shock, and this extra shock, that's what we're predicting. They want to benefit from the extra, that something extra we anticipate, right? So that's the idea. So that's volume that we're predicting, the shock. And if you think about it, so if you measure auto sample R squared, you can see this is the volume predicting the shock of the volume. So you can see here that so we use different techniques here. This is OLS when we have all the predictors, and we use neural net and we use RNN. And these are the prediction as the algorithm gets more complicated, right? So the precision of out of sample predictability volume increases. And this is the shock, right? It's like a predicting change in the prices. right? So there's a price level, and then what we are predicting change in price next day. So this is the predicting shock. The difference is change in price next day. It's very hard to predict, right? So the out of sample R squared, they're all close to zero. Changes in volume are easier to predict, and especially for mega cap or large cap stocks, you can get to precision of 32. So now given that we can actually fairly better predict volume, right? So what we can do with that, right? So this is going to be the next thing is, and this is predicting the shock. Now we're going to move into the portfolio strategy based on this prediction. How do we spin this predictability into portfolio optimization? So there are a few things here. What is your portfolio? And again, I mentioned earlier, we're going to fix our weights, right? So I know what I want to buy, and I know the weight I want to buy in those stocks. So the only thing is, so the difference between what I want to buy, it's X star versus where I am right now, X zero. How do I get there, right? So say if I'm managing 1 billion, right? So, and I want to rebalance 1 billion, I'm not going to just rebalance it like in a spin of a second in the market, because I'm going to crush that stock, right? So if I send in a huge buy, right? So essentially for the large portfolios, and majority of institutional investors are managing these quite large portfolios. So this is kind of the journey from X zero to X star, right? So, and how we get there. So there is tracking error, right? So first it's the difference between X zero, X star, how fast I'm going to get there. So this one trade-off, and obviously I want to be on the paper, we get to X star right away momentarily, right? So we don't, when we do portfolio sorts, we don't care about it, right? So, but getting an X star on a large assets under management can be more complicated than that. And the other thing is trading costs. So there is a trade-off between this tracking error that you want to minimize. You want to get to that where you want that position, versus trading costs that if you trade too fast, you're going to create more price impact, right? So if volume is low, means liquidity low. So you're trading too fast, your trading cost is going to be too high. So you're basically burning alpha already by creating this price impact. So then your participation rate is going to be Z, what we model here. And the idea here is if the volume is low, it means if you start trading very aggressively, Z is very high, you're gonna burn alpha right away. By the time you get to X star, it's gonna be burned in trading cost, for its extreme case. So if your volume is low, and it means your pricing is gonna be high, so your participation rate is low, right? That day you're gonna stay out of a market. You're gonna wait till when you predict this volume is going to be higher compared to the average, you're going to trade more, and then you're going to be pacing yourself to X star. Okay, so far so good. Sorry. All right. So essentially you have a tracking error, right? So this tracking error is X star. Well, we're going to minimize quadratic function, right? So and mu here is going to be a sort of like coefficient of risk aversion, right? So which depends on your AUM. So if your AUM is small, right? So your mu is high, right? Because you want to get to that X star very fast. But if your AUM for here is very large, if you're 10 billion or 100 billion, right? So you can tolerate more tracking error, right? Because when you manage in 10 billion portfolio, you care a lot about trading costs. So your mu is gonna be lower, right? And it kind of makes sense when it comes to the reality, right? So the price impact of your trade is lower when your AUM is lower, right? So your mu you want to trade more aggressively when your AUM is lower, so your mu is going to be higher, right? Mu is how aggressively you're willing to trade to get to your position. And then you have trading costs, right? So, and they are modeled very simplistically here. So lambda is a trading cost. It's again, trading cost quadratic function that you minimize. And essentially what it means that price impact is linear. So trading costs are linear in price impact. They are modeled very simplistically here. And this is the price impact here. If you want to get from x0 to x, right? So if you're buying 10% of daily volume here, right? So it's going to cost you 1%. Your trading cost is going to be 1% of a portfolio, right? So this is the price impact, right? So it's proportional to the linear to trading cost. All right. So essentially what we're going to minimize here is we're going to minimize both based on the conditional information. What kind of conditional information is we need to choose well, volume. We need to choose volume here. Lambda is here and we don't know lambda. We need to estimate volume. So volume is predictable, right? So now we're gonna see how this predictability can enter into the portfolio optimization. So this is a short talk, so I'm gonna skip a lot of it, right? So, but essentially, this minimization function can be rewritten in a more simple form, and this is the simpler form of that function, and the z here is going to be participation rate, right? So these are small steps from x0 to x in one day. X star, that's where you want to be eventually, right? So this is the kind of part of the equation, and then what we're essentially going to minimize, we're going to minimize this part of the equation because x we're going to fix, x star we are going to fix it, right? So it's going to be as given as I mentioned earlier, but we want to minimize it the participation rate and trading cost of getting to the x star, and we're going to name this loss economic loss. Okay. So, and again, z can be between 0 and 1. So 0, you don't trade at all. 1, you trade 100% and you get to x star right away. So how z works, let me show you. So there is the decision function or policy function, and it's a sigmoid, right? And this is the distribution of volume over here that you saw. And so essentially this sigmoid, the blue line is the mu. There are different levels of mu, but let's look at the blue line. It's the dashed line here is a larger mu. That's where you trade more aggressively. But in any case, when the volume is very low, z is 0. You don't trade. When the volume is at its highest, so you trade 100%, right? At the peak, you trade close to 100%. Obviously, when you trade more aggressively, your mu is larger, meaning your AUM is smaller. For every volume you trade more, your participation rate is higher, right? So this sigmoid function of how this works, right? So now how we're going to turn, so essentially the idea here, how we're going to turn our predictability of volume shock into the z participation function. All right, so there are two ways to do that. So we have this statistical loss, which is mean squared error. That's what basically everything is based on, econometrics, right? So the data science. And we're going to call it the plug-in approach. So we have economic loss. And so we estimate in two steps. We estimate volume. And then when we have estimated volume, we're going to plug it into policy function. We have our participation rate. So this is the statistical approach. I'll skip the rest. And now we have economic approach where we actually learn participation rate. And we're going to be actually, the algorithm is going to be learning the participation rate from an economic loss function. So the difference is mean squared error versus economic loss. It's just kind of like two functions, right? We're going to optimize. And when we're minimizing, instead of minimizing mean squared error, we're going to minimize economic loss. We're going to be learning z participation rate. At the same time, we're going to be backing up the volume estimate while learning about z. So this is economic kind of learning. That's I'm gonna just walk you through the economic learning just in a second. So if you use pure statistical approach, you're predicting the volume, right? Plug-in approach. So you predict volume and then plug it in into the policy function, and you have your rate, trading rate tomorrow, right? So it's a sigmoid. So but the way you minimize and mean squared error, right? So this loss function is symmetric, meaning you overestimate volume or underestimate volume, the kind of like the punishment is the same, right? So when you're training this algorithm to minimize, it minimizes basically symmetric mean squared error, symmetric around the target. So when it comes to economic loss, that's where it comes different, because this is not symmetric. This is completely asymmetric. So what this is loss function this is the economic loss, that moment condition, right? So the idea here is that when you overestimate volume, the loss is higher. So for example, when the volume is 4, right? The volume is 4, the blue line here, right? But you forecast the volume is going to be 20. So you get the highest punishment, right? So here, your economic loss is going to be highest, right? Compared to over here. So what comes with economic conditions is that when the algorithm is learning, predicting volume, right? It overemphasizes, overpunishes on when you overestimate volume mistakenly, rather than when you underestimate volume and the volume is high, right? So if you underestimate volume and the actual volume is high, your opportunity costs, your loss associated with opportunity cost of trading less when the volume is really high, it should be trading more. This loss is lower than the actual loss. Sorry, when you overestimate volume, but the actual volume is low. So when you overestimate volume, but the volume appear to be low and you trade a lot, so that's where your economic loss is going to be the highest, right? So that's where you burn your alpha. And then when algorithm recognizes this and it over penalizes overestimating volume, right? More than underestimated volume, right? So this is the whole different learning, right? So, and this learning, economic learning, are going to make a huge difference here in a portfolio optimization. And this is actually another kind of technical part of this contribution to this paper, because that's actually goes to it goes to economic learning here, and it shows the difference between economic and statistical learning. All right, so let me just talk a little bit about this architecture, about transfer learning. So essentially, this is economic learning, and we are learning about participation rate. So this is the only trainable network here is this. So and this is network. When we predict, we have these 125 predictors for each stock, and we predict for each stock every day the shock to the volume. Then with the shock to the volume, we add to the moving average, so we have volume estimate, right? So first we pre-train this network in blue, and then we are minimizing economic loss, and the search parameter here is Z, participation rate. Now, participation rate here is gonna depend on mu. So mu gonna be another hyperparameter, and mu is really gonna be related to your AUM, right? So we're gonna get a series of mu. So, and the higher AUM, the lower mu, right? So essentially, so for the range of mu, we're gonna learn what the best participation rate, and then we're gonna fine tune it further. We're gonna fine tune this model further for the shock. So essentially, given our objective, we're kind of forecasting volume given our objective, right? We're learning, gonna know our range of mu given our AUM, and we're gonna, given that how aggressively we want to trade, we're gonna fine tune further the economic loss. We're gonna learn our participation rate, And through this, we're going to further fine-tune or refine the forecast of this trading volume, right? So this is the fine-tuning essentially. But fine-tuning is, you can think about it, just we are learning about Z and relax. This is pre-trained. Blue is going to be pre-trained, right, for plug-in approach. So this, we're going to, once it's trained, we're going to just plug it in a plug-in first statistical learning. And we're going to have our Z. What we're going to do here, we're going to actually learn, we relax the model parameters further. We change the objective function. It's going to be economic loss function. And we're going to further fine-tune this prediction over here while learning about optimal participation rate Z, right? So so this is the idea. And again, it's a kind of transfer learning. This I can skip for the purpose of time. And so so performance. So we're going to use this kind of AUM 10 billion portfolio, 1 billion, and 100 million portfolio. So in the paper, we also have 10 million, but just to decrease. So we're going to have different approaches. So the first, we're not going to predict volume. We're going to use just moving average. We're going to use past volume, right, to sort of as a predictor, right? And then we're going to use OLS, neural nets, and RNN, and then economic NN and RNN these are the economic loss function. So everything before is just a statistical mean squared error optimization. That's why a reduction in mean squared error here is the same everywhere, right? But when we start learning about Z, right? So that's average Z across different mu, right? So then we have different economic outcomes. So if you look at the reduction in mean squared error, so oracle here is that when we don't predict volume, we have look ahead bias. This is oracle. We know what the exact volume is. And if we minimize mean squared error, so a reduction is 100% when we know what volume is, we know future volume. And these are different reductions in mean squared error. And you can see that they don't work for everything, right? As the statistical function, especially for 1 billion or 100 million per portfolios, the reductions are actually increase in mean squared error. And here the mean squared error is actually better when we use just a plug-in statistical approach. Now, if you look at the reduction in mean economic loss, right, and that's what we're after, when you have perfect volume predictability, you get 100% reduction. So your error is zero. And then so here reduction in economic loss is actually increases here, right? So, and when you use economic loss function, that's where you have the biggest reduction. And this reduction range from 43 to 70%, right? And you get the most of reduction when you have 100 million AUM portfolio, right? So, and again, how you think about this economic loss, right? It's you can think about it as a economic utility, right? It's a utility function essentially. So instead of optimizing statistical function, we're minimizing mean squared error, we are minimizing utility function, right? And we're learning about the utility gains. And these are the gains. You can think about this as the gains, economic gains, when you actually use economic loss function and you're learning your participation rate. These gains are very sizable. And they get better with the RNN, with the slightly more, well, they're very similar, but slightly better when you use RNN rather than neural net alone. If I have not lost you yet, because I don't see everybody, I continue. So this is going to be a little bit easier because now we can trade. And how we're going to trade? We're going to create an unrealistic trading strategy. We're going to fix our target. I'll skip how we're going to fix it, but with the probability 1%, basically, we know that we can identify stocks that next 5 days going to have either positive or negative returns, right? So this is we fix it with for 1% of the stocks in the trading universe we're dealing with, right? Not for all stocks. And then we're going to take long short position. Obviously, it's a crystal ball, 1% crystal ball here. But again, we want to have it fixed, right? So it's very profitable. Sharp ratio 7 is great. It's not achievable. But what we want to do is we want to trade based on what we fixed. We don't want to go and try to identify optimal weights here. We want to see how our trading cost timing can perform. And let me go when we have all 175 predictors for all stocks, and these are different these are different AUM levels, right? And these are mean returns after trading costs, and these are Sharpe ratios, right? So 3 portfolio levels from 100 million, 1 billion, 10 billion. And so what's happening here is that the dotted line is Oracle. So what Oracle is, we are not predicting volume. We just take it from a future without prediction and plot it what the performance would be for that trading strategy when we actually trade, right? So after trading costs. And you can see for 10 billion, first of all, Sharpe ratio of 7 is not achievable under any portfolio, right? When you include trading costs, right? So you can see over here, Sharpe ratio 7 not achievable when you start trading and you have 10 billion and you perfectly forecast volume, right? So Sharpe ratio from 7 goes to 3, right? So this is first, this how trading cost limits to arbitrage, even you have semi-perfect signal here. So the returns here, obviously, like these are the returns here. And you also can see that at some point returns from the highest go to 0. Right, the highest return you can achieve with the lowest portfolio, lowest 100 million, right? So, but that's our smallest AUM because their price impact is lower. But at some point, if you trade too much or too aggressively, your signal, even this kind of perfect signal, gonna be wiped out by trading costs, right? So first, this is how trading costs can eat into your alpha right away under any AUM level. And the second, now this dotted line is beautiful, but it's volume from the future that we take, we call it Oracle. But now what if we predict? And if we predict, so you can see this orange, purple economic learning, those are always at the top, right? So there's the top lines here everywhere. And they perform the best, and especially at the top, right? So these are predictions of volume. So, and even then, and you can see there is a drop from Oracle down, right? But it's again, this economic learning predictability is always at the top under any AUM level. So the other thing well, time running fast. So if we take that turnover and mu how aggressively we want to trade turnover, but when you achieve the highest Sharpe ratio, right? When you take those and basically put it in the table, these are the highest Sharpe ratio from previous graph under different AUM level. So these are mean returns annualized, and these are the Sharpe ratios annualized as well. So what you can see here, the largest gain mean return you get for 1 billion portfolio here. So if you use moving average, like past volume, like without any just to predict the future volume, versus when you actually learn to predict the volume through economic learning and your strategy. So this is the return increases quite a bit. When you know perfect foresight of the volume, this is going to be what your return is going to be, right? So you also do have gains on the 10 billion portfolio. Again, this is slightly under 1%, but this slightly under 1% on 10 billion portfolio, which is a very huge magnitude on its own as well. And for the Sharpe ratio, especially for 1 billion portfolio, this is gain almost twice, right? So in being able to predict the volume and trade towards your target. And that's essentially what we call trading volume alpha, right? You can for example, say it's about almost 2.5% on the 1 billion portfolio, right? So when you don't predict trading volume, just rely on average, right? Versus when you predict in trading volume, and Sharpe ratio almost doubles, right? So this kind of these are what we call the benefits of this predictability. Other things are we have 153 factors, and these are long short portfolios. I'll skip the exact, well, and this is 10 billion AUM. We do the same, but only the difference is for the factors. You know the weights, right, in the beginning of a month to construct long short portfolio, and the factors are all characteristics like book to market, size, and 150 other characteristics, but it's long short portfolios, right? So and you know the weights there. It's just about how you trade through the months to get to those weights, right? So, and what we're gonna do here is to measure the percentage gain between using just simply moving average versus RNN, right? So to predict the volume, and the gains are on these factors are on average all positive, right? So there are 150 factors. If you put them into the themes, right? These are the themes like profitability, low risk. So short-term reversal, that's where you trade the most, right? And the gains here are the highest, approximately 1% for those long short portfolios. Okay, so not all portfolios perform, right? So they can have negative alphas, positive, right? So, but what we are measuring here is actually improvement in performance. If instead of like trading when you start actually timing your trades through the month to get into those target weights you identify in the beginning of the month, right? So these improvements are economically meaningful. So to conclude, let me conclude. Basically, okay, I'm done. So the conclusion is we look at the daily stock level trading volume, we predict it, and we kind of turn this predictability into economic value. So again, what is different from what other people were doing? They would predict it unconditionally. We predict it conditionally within our portfolio optimization. We kind of bring this predictability and to show the value of this predictability in portfolio management on the different AUM portfolios. So these are who can, from academic perspective, we are the first to bring together these two literatures, right? So microstructure, liquidity, but actually how liquidity enters into your alpha, right? So from a practical point of view, it provides a framework not to trade unconditionally, how to trade conditionally, right? So when you, especially for institutional investors who have these large portfolios, more than 100 million. And I think it's good time for me to stop and see if there are any questions.
Thank you very much, Russ. It's a great talk, very stimulating. So now I pass over to Mirco for questions, comments.
Yeah, so hi, Russ. So one provocative question based on my reading of your introduction. So I don't agree with one of your sentences, so I would like to hear what is your take on that? So at a certain point in the introduction, you mentioned that these volume predictability exercise makes sense if and all these asset allocation exercise when you focus effectively on what an individual investor would do if he or she was able to predict volume makes sense if each individual investor that you're considering is small enough not to affect with its volume the entire trading volume that you're trying to forecast. But on the other hand, the type of information that you're using to forecast the volume is publicly available information available to all asset managers. And let's just say that these asset managers are more or less doing the same thing. They are active fund managers investing in the US stock market. I guess that their strategy is they are more or less very similar. And so they're using the same information. So I don't really agree with your statement that, well, that they are all trading in a completely different way, in such a way that they don't affect the entire total volume, because if they're using the same information, they're following similar strategies, they might affect the total volume. So there might be some endogeneity in the individual action of each fund, which is correlated with all of the other fund managers, which might affect the prediction of the volume. And I'm not sure if your model takes this endogeneity into account. But this is provocative, okay? That doesn't mean, I mean, so what would be your reply to this?
It was a long question. It is okay. So I think let me just rephrase if I understood it. People sort of all know what volume is going to be, right? So, but in our context, it would be a moving average, right? So but what we're showing is that exactly that the not to look at, say, moving average, because there are not a lot of gains from using moving average, right? So when we spin it into actually portfolio optimization, that's we show the extra alpha, right? So when we actually when you focus on predicting the shock, right? So and there's a whole idea, just everyone has the same information about the level, but we were saying how about we just start looking at look at the tomorrow shock, and that's how much you potentially can gain in your alpha, right? So your participation rate going to be determined by the magnitude of this shock, right? So this is for institutional investors, right? Individuals, they don't really impact the the market, so it's less kind of relevant for individuals. But when you have kind of bigger portfolio institutional investor, that's where the relevance comes in. Did I answer? Did I understand it correctly?
Yeah, I mean, yeah, partially, but yeah, we can discuss about this later if you want. And then I have another, but yes, partially, yes, you did answer. And then I have, yeah, another question. So why do you need to retrain the neural network for different values of mu's?
Oh yeah. So because it's a different AUM, right? So and then participation rate is essentially it really depends on potential price impact. So your level of AUM determines how much you trade, right? So 1 million invested in one stock versus 20 million invested in one stock. So participation rate is different. So that's why it's retrained for different level of the mu kind of hyperparameter, but it's kind of the range of kind of hyperparameters, and to select where kind of achieve the best for this AUM particular. But it's related to eventually again your 20 million versus 1 million. It kind of has a own price impact, and so we train it for each scenario. So if the volume is medium, and I want to buy 1 million, for me, it's probably gonna be okay. But if I want to buy 20 million of stock, it's not gonna be okay. I really need the higher volume, right? So it's always under this particular scenario, because we are learning my participation rate, right? My Z, which depends indirect now and depends on my AUM. And at the same time, I'm backing up the forecast of volume, right, for my own purpose, right? It's further refining the forecast. And the way that refining works, right? So this asymmetric loss function, right? So if if I need to buy 20 million, I'm most likely I'm gonna be even more scared to overestimate volume, right? So so this is kind of a scenario. It's an economic scenario.
Yeah.
Versus MSE, where there's no economic scenario. When you minimize the mean squared error, it doesn't care. I trade 20 million, 100 million, or $100, right? So all the same. So that the difference economic learning. Actually, this is the part I like the most. The idea that because when you adapt machine learning for social sciences, it's you also need to adapt the function you're optimizing, right? So this is, and when you especially comes to finance, it's a kind of the finance function, a finance fundamental function that you are optimizing.
Okay, and then a clarification question. So from the beginning of your presentation, I had the impression that you are forecasting the error from the prediction of a moving average of order 5.
Shock.
Shock, right?
Yeah.
So the shock. But so what is, so in all your tables of results where you present the out of sample R square or the economic gains, so what is the value that you present for moving average 5? So is this the assumption that the shock is, so what is that?
Those are out of sample R squared for the shock, right? So when I have a moving average, it contributes completely zero to reducing mean squared error, right? So the
Yeah, so that means that, yeah, so that there is, you're assuming that there is zero shock. That's what you mean by moving average?
it is zero
I
shock.
see. Okay, okay,
Correct,
okay.
yeah.
So there is no, so it's not that you're using a moving average of order 5 to predict the shock. No, you're assuming that the shock is zero.
You're right, that's correct.
Okay,
So
okay. So that was just a clarification, which might be very important for
that's the shock that they create the whole economic value, right? So
Okay.
it's basically you just basically want to time those favorable condition, and those favorable condition also linked the degree of favorability,
Yep.
which depends on the level of AUM, how much of price impact you can create, right? So all of that is embedded in here.
All right. And final question, then I leave the floor to everybody else. You're using some machine learning techniques like neural networks or variations of that, which are basically trying to use efficiently the information from many predictors to predict volume according to some objective function that you clearly explained. Do you have an idea which are the predictors which matter the most for the economic predictability that you care the most, which can be identified using something like Shapley values or, all these type of statistics which tell you among a large set of predictors in a very messed up econometric or machine learning models, which are the most important predictors? And so do you have an idea which are the important predictors among the
we had it before, but it's just moving averages are important predictors as you would expect, but also like returns, like momentum variables, prices, past prices, volatility are also kind of important predictors of the shock, right? Well, we didn't put it in a paper because we didn't want to deviate from kind of, it's already long.
Okay.
But yeah, we have the idea. We did it before. It's a lot of like past price drift variables also are big part of predictor of the shock of volume. Yeah.
Okay, and then a super final question, which comes from my old knowledge of time series econometrics. So let's say that your moving average process of order 5 is misspecified. So this means that the error, what you call the shock, will have some so let's say that the true data generating process is a moving average of order 8, but you're fitting a moving average of order 5. And so the residual will inherit the additional or the misspecified or the non-model predictability that you have in the original DGP. So it's not surprising that you might find some variables with a lot of persistence being helpful to predict the shock, because maybe your moving average model of order 5 is misspecified. But
it's look it first of all, when you do it Shapley, it gives you kind of uh so the so that it's very valid argument, but if you think about neural nets, they don't necessarily rely on a linear
yeah,
kind
sure.
of. So we just it's we don't know the functional form. So that's why there is an out of sample, and there is a reason we kind of it's just out of samples 2 years. We don't retrain, so we train 3 years, and then we just take it to the whole out of sample. If it was misspecified, it could not work for this long, right?
But does it really matter? Because even if it is misspecified, the neural network will pick up the misspecification. So do you really care about that?
No, but that's what I'm trying to say. I don't.
Yeah. Okay. So you
I
don't care.
would,
Okay.
because there is a lot of yeah. It just I care what works, right? So
Yeah. Yeah. Exactly. So
and if it and it further, and the other thing is further fine tuning, right, on the economic loss function, right? So moves it even kind of removes further that concern, right? So because you actually start more focusing on the economic objective rather than mean squared error, right? So and that's essentially I think it's just big message of it, right? So there is a kind of metrics, and there is social kind of objective that you can want to achieve through the machine learning, right? Not everyone kind of understands how much of benefits you can get from it.
thanks. I'm done with my questions. Actually, it took too much
Thank you,
time.
Mirco. So now we pass over to William.
Yes, sure. Thank you. Well, first of all, thank you for the presentation. Very interesting topic. You talked earlier about the asymmetry effect. Could you elaborate a bit further on the magnitude of that effect and on how much worse it is to overestimate volume at low volume versus underestimate at high volume?
Right. Yeah. So there's the a lot. So mean squared error, they don't recognize when just the that. So this essentially, if you trade a lot when the volume is low versus traded little when the volume is high. When you trade in little when the volume is high, you have opportunity cost. When you trade a lot when the volume is low, you have a lot of trading costs, right? So because your price impact, if your markets are liquid and you choose to trade a lot, right? So essentially, the statistical function doesn't recognize it, right? So, but economic function, the kind of forgives opportunity cost, right? Because because your price impact is when you trade less, but the volume is high, your trading costs are low. But when you trade a lot, when your volume is low, there's no liquidity, and you just trade a lot, that's gonna eat up your alpha quite a bit. And you saw those, sharp ratios go up and down, right? Those are sharp ratios and returns for where the strategy is very profitable, 7% sharp ratio paper trading, right? But even if you completely know the volume and you trade, trading costs gonna bring you to zero, right? Your returns. That's how much trading costs can be. So this is essentially the idea. When you trade too much when the volume is low, that's essentially gonna bring your returns evaporate, right? But if you don't trade a lot when the volume is high and you trade less, you still keep your alpha, right? So you're so that's kind of the idea of this economic function.
Cool. Thank you. I'm not sure, Emmanuel, if we have another time for another
Yeah,
question.
you have time.
Yeah.
You can
Okay.
ask two
Cool.
additional questions.
Yes, you showed earlier three models. What types of patterns or features do you think the recurrent neural network model capture in trading volume that, for example, your simpler model is missing?
Non-linearity. Yeah, so the biggest idea, but again, what you depends. There are pros and cons of using neural networks, or kind of a little bit more kind of complicated algorithms than just linear algorithms, right? So I think the big thing is non-linearity, because the markets, if you think about all our traditional models you learn from investment textbook, and they're all linear, but most of the time, on average, over a long period of time, a linearity probably persists on average. But if you go to day-to-day dynamic, so the markets have become extremely complex, right? And linearity on a day-to-day basis, right, so over a shorter period, might not be as persistent as over long term on average, right? So, and that's what these models bring, is a non-linearity. So the between different predictors and different functional forms.
Perhaps the last question, William?
Yeah, sure. Well, since small cap stocks show more unpredictable volume, did you explore other models or predictors only for low liquidity names, and how does it affect the results in those cases?
Yeah, I know we leave it for other people to do, like yourself, maybe for your master thesis. Uh, so this is the relatively generic, right? So the and relatively more kind of have the same approach to all, right? Because the thing is, well, one is the just to make this proof of concept, right? So it's already a lot of pages, right? Just over the very base. So we cannot do like everything in one paper, but that's why kind of this open source academic research, so that other people can come up with ideas, as you just did, and continue developing it further. So open source research.
Thank you.
Okay, thank you. So just before we close down, just one question from my side, Russ. So if I'm correct, you make an assumption on the VCV matrix, right? So you make there is no prediction. You assume that the stocks are uncorrelated and the volatility is constant, if I'm correct.
Right. No covariance, zero covariance. Yeah.
So did you
It's for a
try
reason.
to look? Did you try to look to obviously the combination, as you mentioned at the end of your article? That means what will be in fact the impact of combining the prediction at least of the VCV matrix, or even just the volatilities, the individual volatilities and the trading volume?
Yeah, it's a good question. I think the factor, when you do go to factor those 100 or 50 factors, that's where there's no assumption on diagonal matrix, right? So this assumption is for a reason. First, to simplify function, but second most because we fix the weights we want to get to, right? So we don't care about covariances. We know what we want to buy. It's already optimized, right? So in this case, we don't do portfolio optimization. Those weights targets already set, right? And we know they are profitable. And now how are we going to get to those targets? By trading. So trading is what we want to optimize. So it's completely different from mean variance optimization, right? So when we are optimizing returns, and then you want to, okay, and what would be the trading cost to get there, right? So we do opposite, right? So we set the weights, and we're optimizing participation rate by learning from predicting the volume shock, how to get to those weights. So for that experiment, we don't necessarily need it, right? But the closer it gets to what you're asking when it comes to factors, because there we don't make any assumptions, right? Because factors are long short, right? So we know the weights in the beginning, right? It's like book to market, right? HML. And we just need to find the optimal rebalance. And so when you construct those factors, you trade in the beginning of a month, right? Everything. But but if you start actually trading them, so how much of the high minus low alpha you're going to gain into actually predicting volume, right? So that's closer to more kind of realistic scenario.
Okay, so thank you very much. So thank you, Russ. Thank you, Mirco. Thank you, William. So this is the end of this session. Just to mention that we'll be back next week, another session. We will still talk about AI. We'll have the pleasure to welcome Professor Ramakon from Oxford that will talk about how to use GenAI to hedge derivative instruments. So thank you very much. Thank you again, Russ, and
Thank you.
I'll see you soon. Thank you all. Thank you.
Thanks.